You are staring at a tangled web of corporate ownership. Like,
Oh.
Company A owns a massive piece of Company B.
Right, which is always a headache.
Yeah, and then Company B is constantly selling products to Company C. And, well, your brain just completely freezes when you are asked to combine their financials into one clear picture.
Oh, absolutely.
Whether you are, 23 and cramming on a commuter train trying not to panic before your FA or FFA exam, or you are 38, a manager trying to review group accounts during a rushed lunch break, you both have the exact same problem.
Yep. You're just trying to figure out who actually owns what.
Exactly. But what if I told you the hardest part of consolidation isn't the complex math at all, but a single, optical illusion that examiners use to actively trick your brain?
It is a brilliantly designed illusion, actually. I mean, we are taught our whole lives to look at numbers in a very specific, proportional way, right?
Yeah.
And this entire topic basically requires you to flip that instinct completely upside down.
Well, welcome to our global audience to this deep dive. Today we are covering the FI syllabus on consolidated financial statements. We will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
Sounds perfect. And setting the foundation for this is critical because literally everything else builds on it.
Right.
So at its absolute core, consolidated financial statements present the assets, liabilities, equity, income, and cash flows of a parent company and its subsidiaries as if they are a single economic entity.
Okay, let's ground that in something familiar for a second. It is exactly like a family household budget.
Ah, that's a good way to look at it.
Right. Because even if the parents and the kids have entirely separate bank accounts or different credit cards and different jobs, when you want to know the family's true, overall financial health, you have to pour all of those statements into one single pot.
Exactly.
Like, you don't look at the teenager's checking account in isolation to decide if the family can afford a mortgage.
No, you draw a boundary around the entire family unit.
Yeah.
The fascinating part of corporate accounting, though, and this is where it gets interesting, is how you define who actually belongs inside that family boundary.
Right.
Because, people naturally assume you need to own the vast majority of a company to consolidate it. But actually, you can be forced to consolidate a company even if you own less than 50% of its voting shares.
Wait, hang on. Less than half.
Yeah.
How does that work in reality?
Yeah.
Like, if I own 45% of a company, I objectively do not own the majority of it.
Because control isn't just a math equation about the percentage of shares you hold in a vault somewhere. It is about practical power.
Okay, practical power.
Yeah. Let's say you own that 45%, but buried in the corporate charter is an agreement giving you the exclusive power to appoint or remove the majority of the board of directors.
Oh, I see.
Right. The board makes the rules. The board hires the CEO. If you control the board, you run the show. You dictate the operating policies and control the returns. Therefore, you must consolidate.
So the fundamental definition we are dealing with here is that consolidation reflects absolute power and control, not just equity percentages.
Exactly. And understanding that difference is, well, it's why this matters so much outside the classroom. I mean, corporate acquisitions are happening constantly in the real world.
Yeah, every day.
When senior leaders or external investors look at a massive corporate group, they need to see the true economic health of the enterprise without the distortion of all those internal dealings. They need to see the reality of the business power dynamics, not just the legal paperwork.
Which brings us to the exams, of course.
Naturally.
There are 2 reasons examiners love this topic. Here's the first. They love testing if you can spot the difference between voting equity shares and non-voting shares.
Oh, they do this all the time. They will routinely give you a scenario where a company buys 80% of another company's shares. And your brain, it immediately lights up, right?
Yep, 80 is more than 50.
Exactly. 80% is well over 50. You just assume you have control. But if you read the specific wording, they are 80% of the non-voting preference shares.
The word non-voting is the trap there. I mean, you might have a right to some dividends, but you have 0 steering wheel.
Right.
No vote means no power to make decisions, which means 0 control over the entity.
It is a classic misdirection. And the second reason examiners love this topic is they want to see if you will fall for the trap of treating a subsidiary like an associate or vice versa.
Which is a huge deal.
It's massive. The underlying mechanics for each are completely different. If you get the relationship wrong in the very first step, literally every single subsequent calculation you make will be wrong.
Examiners just love setting traps where the most obvious math is actually the wrong math.
Yeah, they really do. because they are probing your conceptual understanding of the mechanisms, not just your ability to punch numbers into a calculator.
Right, well, there are three parts to this. Let's take them one at a time. And we'll use a scenario we see in the headlines basically every day.
Sounds good.
Imagine a massive, globally recognized tech giant that wants to dominate the artificial intelligence space. To do that, they acquire a breakthrough AI startup. Let's look at part one. The relationship. Are we looking at a subsidiary or an associate?
Well, this all goes back to our definition of power. So, if the tech giant has control, meaning they bought more than 50% of the voting shares or they secured that board control we talked about, the AI startup is a subsidiary.
Okay.
Because the tech giant controls it, they consolidate line by line. They add the startup's revenue to their revenue, the startup servers to their servers, just line after line down the statement.
But what if they merely took a sizable stake, say 30%?
Then they only have what's called significant influence, which typically falls in that 20 to 50% range of voting shares. That makes the AI startup an associate. So you absolutely do not consolidate line by line in that case. You use equity accounting. You simply bring in one single line on your statement showing your specific 30% share of the startup's profit.
Simply put, control means you absorb everything. Influence means you just take your slice.
Exactly. That's a great way to summarize it. So let's assume the tech giant bought 80%, establishing clear control. The AI startup is officially a subsidiary.
Okay, that brings us to part two. Intergroup balances. Now that they're a family, the parent and subsidiary are obviously going to do business together.
Right.
Let's say the tech giant provides cloud hosting services to the AI startup, and the startup owes the parent $4,600 at the end of the year.
Well, because we are treating this group as a single economic entity, that internal debt has to be completely eliminated in the consolidated accounts. Like, a single economic entity cannot owe money to itself.
Yeah, if I take a $20 bill out of my left pocket and put it in my right pocket, the jacket as a whole didn't just generate $20 in revenue.
Huh.
And my right pocket doesn't magically owe my left pocket $20.
Exactly. I mean, in their individual accounts, sure, it shows as a perfectly valid receivable for the tech giant and a payable for the startup. But on the consolidated balance sheet, both of those figures must vanish.
Because it's an illusion.
Yes. If you don't eliminate them, you artificially inflate the size of your company to investors, making it look like you have more assets and liabilities than you actually do in reality.
Simply put, internal debts cancel out.
Always.
Every time.
Okay, so internal debts disappear. But wait, what happens if the tech giant isn't just hosting data, but like selling physical inventory to the AI startup and making a profit on those sales? That brings us to part three. Unrealized profits, often referred to as PUP.
Oh, PUP. Yeah, this is a major stumbling block for a lot of people because it requires you to understand the actual mechanism of a sale.
Yeah.
You cannot make a profit by selling to yourself.
Let's say the tech giant manufactures specialized servers for $4,000 and sells them to the AI startup for $5,000. In the tech giant's individual accounts, they just recorded a clear $1,000 profit.
And the sales team at the tech giant is probably celebrating. They hit their quota.
Oh, they are definitely celebrating. But if those specialized servers are still sitting unboxed in the AI startup's warehouse at the end of the financial year, they haven't actually been sold outside the group. From the perspective of the single economic entity, no new wealth has been created. The servers just moved from one room of the corporate house to another room. That $1,000 profit is a total illusion.
So how do we fix the math to reflect reality?
You have to perform two distinct mechanical steps. First, you eliminate the internal sales revenue entirely. That $5,000 intercompany sale never happened for the group as a whole.
Okay, that makes sense.
Second, if half of those servers are still sitting in the warehouse, that means half of that $1,000 profit, so $500, is completely fake. You have to remove that $500 fake profit from both your inventory value and your cost of sales.
Simply put, if the inventory hasn't been sold to an outsider, the profit isn't real.
Right. And if you fail to adjust for that, you're essentially lying to your shareholders about the value of the inventory sitting in your warehouses.
Wow. So to bring that together, consolidation is basically the process of stripping away all the internal family drama, the internal debts and the fake profits, all to show what the corporate group actually owns and owes to the outside world.
That is the essence of the entire syllabus right there.
So let's dig deeper into our global real-world example to see how the biggest calculation of them all actually works. When our tech giant acquires 80% of this breakthrough AI startup, they aren't just paying for desks and monitors, right? They are paying a massive premium.
They are. And that premium is called goodwill. Goodwill is the excess amount you pay over the actual tangible fair value of the company's net assets. You are paying for their brilliant machine learning engineers, their proprietary algorithms, their future market dominance.
The intangibles.
Exactly. Things you can't easily put a price tag on.
So how do we calculate this goodwill for our tech giant and AI startup? Let's walk through the mechanics slowly.
Yeah.
Step 1, the consideration transferred.
This is literally just the cash or shares that the tech giant handed over for their 80% stake.
Okay.
Let's say the AI startup has 40,000 shares in total. The tech giant buys 80% of them, which is 32,000 shares.
Right.
And they pay a premium price of $3.50 per share. That means the consideration transferred is $112,000.
Now, if you are early in your career and prepping for an exam, pay close attention to the mechanism here. Focus on calculating the exact consideration transferred based on the shares actually purchased.
Yes, this is crucial.
Do not accidentally multiply the purchase price by the full 40,000 shares if you only bought 32,000. You only paid for the slice you bought.
Correct. Now, step 2 is where things get conceptually tricky. We need to account for the shares the tech giant did not buy.
The other 20%.
Exactly. This is called the non-controlling interest, or NCI. We need to determine the fair market value of that remaining 20% at the exact date of acquisition. Let's say the market value of that 20% slice is $30,000.
Okay.
We take that $30,000 and we add it to our $112,000 consideration.
Hold on. This is where the logic always stalls out for people. We only bought 80%. Why on earth are we dragging the other 20% into our calculation to build a 100% picture?
It feels weird, I know, but it's because of the single economic entity concept. Think about the 38-year-old manager reviewing these accounts. They need to put the total value of the goodwill on the group balance sheet. Why? Because the tech giant controls the whole asset.
Oh, the power dynamic again.
Exactly. If they want to shut down the AI startup server farm, they can. They don't need the minority shareholders' permission. Because they control 100% of the entity's operations, they must calculate the premium on 100% of the entity.
Right.
So we add what we paid to what the others hold to get the total 100% value.
Okay, that makes total sense. It's the total theoretical price tag of the entire house, not just the rooms we paid for.
That's a great analogy.
So we have $112,000 that we paid plus $30,000 for the NCI. That gives us a total combined value of $142,000. What is step 3?
Step 3 is comparing that massive price tag against what the company is actually worth on paper. So we subtract the fair value of the AI startup's net assets at the time of acquisition.
And assets.
Yeah, net assets are just the tangible things they own minus what they owe. The cash, the servers, the patents, minus their bank loans. Let's say the fair value of those net assets is $125,000.
Okay, let's do the math. We have a total 100% company value of $142,000 minus the tangible net assets of $125,000. The leftover amount is $17,000.
And that $17,000 is your goodwill at acquisition. It represents the intangible magic of the AI startup that the tech giant was willing to pay a premium for.
And that right there is exactly what the examiner is testing when they ask you to calculate goodwill at acquisition using the fair value of the non-controlling interest. They want to see if you understand the mechanism of adding that $30,000 NCI into the mix to build the full 100% picture before you subtract the net assets.
They absolutely do, which leads us directly into the single biggest conceptual trap students fall into.
What is the most common mistake people make when putting these consolidated statements together?
Without a doubt, it is prorating a subsidiary's balance sheet based on the ownership percentage.
Oh, wow. Walk us through how that error happens.
Let's stick with our tech giant. So they own 80% of the AI startup. When it comes time to consolidate the cash sitting in the AI startup's bank accounts, a student will look at the balance and say, well, the tech giant only owns 80%, so I should only add 80% of the startup's cash to the consolidated accounts.
That feels incredibly logical, though. I mean, claiming 100% of the cash when you only own 80% feels almost fraudulent. Why is that wrong?
It's wrong because it violates the core principle we established in minute 1. And it is a fascinating metacognitive error. Your brain is essentially trying to be fair.
Fair.
Yeah, it thinks, I only own a fraction, so it's dishonest to claim the whole thing. The brain is confusing the concept of ownership with the practical mechanism of control. Think about it. If you have the checkbook for that AI startup, you don't call up the 20% minority shareholders to ask permission to buy a new server.
No, you just buy it.
Exactly. You have the power to spend 100% of that cash.
So your brain is trying to be democratic and fair, but accounting doesn't care about fairness. It cares about who makes the decisions.
Perfectly said. If you establish control, the math is entirely binary. You add 100% of the subsidiary's cash, 100% of their liabilities, and 100% of their revenue line by line every single time. Never prorate a subsidiary's statement of financial position.
It all comes back to that optical illusion. The percentage of ownership is just a distraction once that threshold of control is established.
It is the ultimate distractor, and examiners know your brain wants to fall for it.
Okay, so let's get into your exam edge. Three things. Here's number one. Look closely at the exact type of shares in the question scenario. 30% of non-voting preference shares gives you zero significant influence. Don't let a large percentage number blind you to the word non-voting.
That's a great tip. And tip number 2. When dealing with intragroup sales, eliminate the total sales revenue completely from both sides, regardless of what is left in the warehouse. But only calculate the unrealized profit, the PUP, on the specific items that remain unsold in inventory at year-end.
Tip number 3, read the goodwill requirement carefully. Are they asking for the goodwill at acquisition, which is the full calculation using NCI that we just walked through, or are they just asking for the cost of investment in the parent's individual books? Answer exactly what is asked.
Right.
Because if they only ask for the cost of investment, they just want that $112,000 initial consideration. Nothing else.
Yeah, doing extra math that wasn't asked for is the fastest way to talk yourself right into the wrong multiple choice answer.
Definitely. Remember our core idea today. Consolidation reflects 100% control, not just your percentage of ownership.
And if you are early in your career, follow the mechanics of these rules step by step. Don't rely on intuition, rely on the process, and those examiner distractors won't stand a chance.
And for the experienced professionals listening, mastering this means you no longer just see numbers on a page. You see the true economic reality, the internal workings, and the power dynamics of any business deal.
You learn how to see through the illusion.
Which brings us right back to where we started.
Yeah.
That tangled web of corporate ownership company A owning B selling to C, it doesn't have to freeze your brain anymore.
It really doesn't. And, I'll leave you with one final thought to mull over. If consolidation is all about reflecting absolute control, imagine what happens to that single economic entity when control is suddenly lost.
Oh, interesting.
Yeah. A fully integrated, massive subsidiary can instantly vanish from your consolidated balance sheet, reverting back to a single line item on a page. The entire economic reality of the group transforms literally overnight.
Wow. When you know how to look for who holds the real power, the whole financial picture snaps into focus. To our global audience, thank you so much for joining us on this deep dive. If you found this breakdown valuable, please follow the show on Spotify and leave us a review. It really helps us out. Thank you for listening.